Now let's look at a model that works, the institutional model, which, as you will see, differs from the retail model in some very important ways. One is the way they do business, and the other is how they invest. Both combine to explain why institutional investment returns generally trounce retail returns. Let's look at the way they do business first. Institutions shorten the pathway to the capital markets. They do this by going directly to the asset managers they want to use. There is no gauntlet when making an investment in the capital markets. Often they will use independent investment consultants to create their investment portfolios and select the active asset managers that best meet their needs. What they do is cut out middlemen, then they use their scale to negotiate directly with the asset managers to get the best possible fees. It is this direct approach that creates a lot of value when it comes to investment returns. Now let's look at how they invest. When institutions invest, they do it with the recognition that there is not one, but two stock markets. Let's look at the two markets. The first is the efficient market we talked about before. It is a market that is made up of very large companies that are widely known and held by investors, a market that institutions know is extremely difficult to outperform. The second is referred to as an inefficient market, which is made up of smaller, less well-known, and not widely held companies. This is the part of the stock market where inefficiencies in pricing create market-beating investment opportunities. The most common portfolio strategy for institutional investors is known as alpha-beta separation, a strategy that blends active portfolio management with the benefits of passive portfolio management. In the efficient market, they want to capture market returns, a shorthand for beta. The goal is to achieve broad-based diversification, a strategy that doesn't try to determine which individual stocks are better than others, but to invest in an entire market of stocks, such as the S&P 500 index, in order to participate in the historical upward bias of the equity markets. They want to achieve this at the lowest cost and most tax-efficient way possible, using index and exchange-traded funds. It is in the inefficient markets where securities are inefficiently priced that they seek above-market returns, referred to as alpha. It is here that institutions hire skilled active managers, who with hard work and intelligence can find superior companies, whose stocks will generate higher rates of return than the overall market. It's easy to see this strategy in the way the major institutions optimize their assets. About 45% of their assets are indexed for beta, low-cost, tax-efficient market exposure. And the other 55% is split between traditional and alternative active management, both going for alpha in the less efficient markets. Distinguishing alpha from beta matters because the fees for beta should be very low. You won't find institutions using closet indexers. Keeping these fees low creates one of their major performance advantages. Focus on the middle box. Retail investors still have almost 90% allocated to traditional active managed investments. Why? Because this is where retail asset managers, distributors, and advisors collect their fees. It is here that the retail investors continue to pay billions of dollars for closet indexing that is really beta masquerading as alpha. Yale is the country's best performing endowment. Over the last 20 years, it had annual returns of almost 16%, which grew the endowment from $1 to $23 billion. David Swensen is the chief investment officer. Here is his take on efficient markets. The most sensible approach is to implement with low-cost, passively managed index funds. You'll wind up beating the overwhelming majority of participants in the financial markets. On inefficient markets, inefficiencies in pricing allow managers with great skill to achieve great success. The institutional model differs from the retail model in these distinct ways: cutting out middlemen to shorten the pathway to the capital markets, using scale to negotiate directly with the asset managers to get the best possible fees, and alpha-beta separation to create a well-structured portfolio that matches asset management to market efficiency. The result is better performance, pure and simple.